This is Brian Akers from Akers Financial Group, and we welcome you to our mid-year market report. Mark DiOrio from Brookstone Capital Management will be with us. We'll go over our AFG Select portfolios where we manage alongside Brookstone assets for our clients and their design. And of course, we're going to invite you a few times to our financial forum. We used to call it Training Day, but it's our financial forum September 11th at Water's Edge. It's going to be a day full of information, full of classes to help you get ready to retire, help you maximize retirement, lots of things to help you pay the least amount of tax, make your money grow and stretch over time. And we especially teach you the Akers way, in financial planning, investing, insurance, health insurance. And of course, we have some fun classes, food and music by Trish and Andy. One of our employees, Andy Gridlock, him and his wife will be playing music for us at night. Today's talk, we're going to begin with Mark DiOrio from Brookstone Capital Management. He's the Chief Investment Officer. We manage money actively for clients, and we use Mark DiOrio through Brookstone Capital Management to manage part of the portfolios there. He'll give us a market update. We'll have him here just in a moment. I have Mark DiOrio with me. Mark DiOrio from Brookstone Capital Management. He's the Chief Investment Officer from Brookstone Capital Management. We work with them as our third-party money manager in their active management portfolios. Mark, I want to talk to you about the market. I'm looking forward to your display of the magical charts. Are you ready to give us this talk, Mark?
Yeah, definitely. This is kind of like the first quarter, Brian.
Well, it's like the second quarter. We're halfway through the year already. 6/30/2026. It's flown by, and we got 6 more months to go. So I know we're going to have you go through some charts, and I'm going to interject sometimes. Hopefully, you'll let me do that. And then what we'll do is we'll talk about the future of the market a little bit too, and then we'll come back together at the end. So, Mark, you want to go ahead and start with the charts, and then we'll have a little bit of fun.
Yeah, sounds good. Let me pull those charts up.
And so, Mark is running at Brookstone Capital Management about $14 billion now. Is that true?
That is true. Yep.
How about
And
that?
yeah. And I think when we met, we were probably around $1 billion in assets. And so it's been a nice run for sure.
Absolutely. That's incredible. Akers Financial Group, we're at 635 million overall, but we're not at $1 billion yet. So we're trying to get
That
there.
that is fantastic. And hopefully working together, we can get there.
Absolutely. Very true. All right. So you have the floor, Mark. Go ahead.
Okay, so I just want to give a nice mid-year update of where we're at in July. And there's a number of charts I'm going through, but it's really just a touch on kind of the global and economic backdrop. So this is a chart of oil. Oil spiked higher with the Iranian conflict, and so on the right-hand side, it spiked from about 70 up to over 110, touching just shy of $120 a barrel. But it has since fallen all the way back down. So it's a very quick kind of round trip. So right now, oil's in that $70-$75 range. But that is not that unusual in the sense that historically during crisis events, and you can go back to Russia-Ukraine invasion on the left-hand side, that oval circle as well, it spiked higher. But then it started to fade back lower after a couple of months. If you look at the price of oil, whether it's 3 months, 6 months, or 12 months out, it's all converging. And I know it's kind of a busy chart, but it's all converging around that $70-$75 barrel range, meaning it doesn't look like that there's going to be other issues that the market is concerned about. Now, that may change with a heightened sense, but this is really telling you it's not an oil shortage. It is really based on the transportation of the oil, as we all probably know. But when you have a spike in oil, you get concerns about inflation. Even though oil prices have come down, there's a lag before that data kind of flows through. The Fed funds rate is the rate that the Fed charges banks or the short-term rates or the overnight rates. And that really guides where the rest of the interest rate curve is expected to be. The point of this chart is in red, there's the Fed funds rate. So that's what the Federal Reserve says if they raise or lower rates. And then the blue line there is the 2-year Treasury yield. And what's important about that is it usually leads and gives an indication about where the Fed funds rate should be. So should the Fed raise or lower rates? And you look at the 2-year Treasury, and that gives you an indication of what the market thinks should occur. And what's unique about 2026 is that The blue line there, the 2-year Treasury yield, has now gone higher than the Fed funds rate. So not just a little bit higher, it's about a 0.5% higher. So the market's saying, well, maybe the Federal Reserve should raise interest rates. And usually that becomes a little bit more challenging for the markets. So this is something that we're watching. And historically, the markets do challenge a new incoming chairman, Fed chairman, just to see how they'll react. And so this will be interesting to see how this plays out. But this is definitely a key chart that we're watching. What direction do interest rates go, and what policy stance does the Fed take?
What's your thoughts on the interest rates and where they're going in the next few months?
I think the Fed is going to try to hold rates steady to the
Right.
last moment. So I don't think they necessarily want to raise rates
Hmm.
with the thought that, well, oil prices come down already. Just give it a little time and inflation will come down. And in fact, this chart gives you a good example. This breaks down the components of inflation, and inflation is general rise in prices. The green bar there, kind of stacked on, that's energy prices. So the last three readings, all the way to the right, the big jump has really been in those energy prices, and that's what's given a higher reading. And so if now all of a sudden energy prices are coming back down, you should see inflation coming back down lower into a more reasonable range. So that would be my take. I think they're going to wait and see rather than increase rates. The incoming chair has mentioned that he likes to look through, or his stance would be look through kind of crisis or moments in the marketplace to set when you're setting interest rate policy. And the 10-year Treasury yield, going out a little bit further, does wiggle around quite a bit. Every 6 months, it moves about a 0.5%. And right now, it's staying pretty calm, under 5%, but really in a range that it's been in for a few years. And so that's our expectation as well. But there is a risk if it goes higher, particularly if the 10-year Treasury yield goes above 5%. So that's kind of a really important key benchmark in the industry that we're looking at. Now, there's a lot of talk about the K-shaped economy. The K-shaped economy basically says, well, the upper incomes are doing well, the lower incomes are really struggling with the cost of living and so forth. And obviously, that kind of is always true. But what we think is driving the economy much stronger is when you're looking at the data, it's really a G-shaped, meaning a generations-based economy. This chart in the green line there is looking at households headed by those aged 65 and older. And you can see that it has just accelerated since 2010, leaving all the other demographics behind, have basically flatlined. So this is suggesting that you have the baby boomers and the silent generation and the greatest generation and so forth are really determining that. So you have more retirees, a little bit different economy, and together they hold about 100 trillion in assets, which is more than double the size of our economy, almost triple the size of our overall economy. So this has a big influence on spending, and one of the reasons why the consumer has stayed strong overall. And this trend is set to continue. The youngest of the baby boomers do not turn 65 really for the rest of until the rest of the decade. So this is a trend that's going to be with us. And again, this just talks about boomers starting around that 2010, 2011, turning 65, and the retirees and those dropping out of the labor force has really accelerated. And so it's very interesting. And I think it has a big impact on our overall economy. And just for reference, generations, I just threw this chart in there in case we have, for a reference point, 1928 to 1945 is the silent generation. Baby boomers are 1946 to 1964. And then you go Gen X, Gen Y, Gen Z, and then Gen Alpha. So baby boomers are definitely the largest cohort individually, but also where they are from a retirement perspective. One of the risks in this economy or in the global economy is actually the world's number two economy has been in deflation. And this is a chart looking at year over year price movements in house prices. And so it's gone about 4 years it's getting pretty extended with house prices declining. And so that's not a cumulative chart. That's just the year to year. So if you're looking at this from a cumulative, you're looking at about 20% declines overall in housing over the last 4 years. So this is putting stress that the equity markets and bond markets in the US are simply much larger, much more important from household wealth and so forth. In China, it's a lot has to do with the housing market. Now, weakness there also is an impediment to banks and bank lending and consumer spending and fiscal policy as well. And in fact, if you look at housing and real estate stock prices as an indicator, you're back to 2014 levels where it based out at 2012, 2014. And so we're on the verge of dipping below that. And if that breakdown occurs, you may see possibly a radical response from China in terms of an economic policy response. And so that can have different implications overall. So that's something that we're watching and can be a risk. You know, it's been pretty quiet out of China from an economic perspective, but that's one of those risks that we thought we'd highlight. And in fact, Chinese interest rates are the lowest that they've been. They were the highest, that purple line there. Go back 5 years, they had the highest 10-year government bond interest rate. Today, they are the lowest. And you can see kind of this looks at the US, France, the UK, and Japan. They've crossed in late 2025. Japan has higher rates than China does today.
Does that mean they're trying to drive the housing market back up with low interest rates?
Correct. So they're trying to be supportive of keeping those rates low, just like the US did, where we
Right.
kept rates low, helping to cause some inflation or asset price improvement. So that's one of the ways you combat deflation, which is you reduce rates. And then that hopefully stimulates the economy. On the flip side, if you have inflation, then you raise rates. And so right now, China has very low rates, and it still hasn't seemed to got really supercharge that economy like the U.S. ultimately stabilized and started to head higher. So that becomes a risk of what policy they might implement as well. It doesn't necessarily have to be negative. It could end up being very positive. It's just one of those outliers there. And I've heard this in the media for almost a year about the Sell America trade. I don't know if you've heard this, but Sell America, globally they're selling. The data could not be further from the truth. In fact, it's the exact opposite. The world has been buying US assets. What this is a chart of the 12-month inflows into the US capital markets. And you can see the latest, you're almost at 900 billion over the last, and this is just stocks, not including bonds that are purchased, US bonds that are purchased. So this line has just soared over the last year. So probably it's one of the reasons why it's helped support the equity markets and our financial markets. You know, the rest of the world realizes that the U.S. treats assets very, very well. And so we've been a destination for capital flows, definitely has helped our markets. This is a chart of both stocks and bonds. In red, there is the bonds. When you combine these, and this is just private net purchases, not official like government monies coming in. But you're at well over $1.5 trillion in private capital coming into the U.S. And I'm sure people thought that, you know, with tariffs and different policies coming through, that might hurt the U.S. It did not in terms of asset purchases globally. And so when you look at, they actually break down the data that comes into the U.S. from private and official type reserves. And all the way at the bottom, you can see that there is some small selling in official reserve assets, meaning selling some of the treasuries that they may own, whether the central bank of that country owns. They may sell some of the treasuries. It is minute compared to the inflows, as you can see, from private sources. So I think this is really a real telling of what's been happening. Now, obviously, there's a risk if this reverses, but nevertheless, this is the case, and this is the real story of what's happening. From a market's perspective, AI, artificial intelligence, has really driven the 2025 bull market and that story. And it was led by the Mag 7, kind of the largest tech stocks, and they called hyperscalers when they're building out data centers and buying semiconductors. Semiconductors process and store data. Those are those little chips. So you need very advanced semiconductors to basically do a lot of computations and computing to deliver on artificial intelligence. And so it's a lot of money going in. And so there's a lot of excitement. And this chart shows relative performance, relative of the Mag 7 stocks, how those largest tech companies are performing relative to the other 493 stocks in the S&P 500. And so when it's trending up, those stocks are leading. When it's trending down, as in 2026, and that red arrow pointing down, those stocks are underperforming the rest of the market. So this year, it's really been a reversal where those Mag 7 stocks have really weakened relative to the other 493 stocks. And that's really about AI fatigue, meaning you're spending so much money. Now there's a question of, okay, when will the payback be? This money and the spending, the capital expenditures, seems to continue to grow. And so it's natural for the market to take a pause, reassess where we're at, when are the expected profits and cash flows from these investments going to occur. But the rest of the stocks that were kind of left out in 2025 have started to participate in 2026. And this is the performance in green there of those Mag 7 stocks. And you see they're pretty weak relative to the rest of the market. The red there is the rest of the market doing very well. And then blue there is the S&P 500, kind of in the middle. That's how big of an influence 7 stocks have because they're so large on the S&P 500. I know this is a busy chart, but it's really only the third time in the last 50 years that we've had stock dispersion, meaning just a wide dispersion amongst the winners and the losers in any particular period. Really the third highest reading or lowest in this case, suggesting that stocks have not been very correlated with the Mag 7. And the S&P 500 in general. Again, just showing that there's a big dispersion in performance amongst individual stocks. Very unique period. But the market's rally has really been about earnings. In red, there is the earnings or earnings per share of the large cap stocks, and they have just accelerated. And that continues. Blue is mid cap stocks, and green there are small cap stocks. So clearly, the large cap stocks led this rally, kind of led off the bottom, and have really accelerated the last few years. Mid caps broke out, and now, after about a 4-year sideways action in terms of earnings, not really growing, getting back to where they were, now small caps have broken out. So that's part of the story of why both the small cap and mid cap earnings breaking out, you see more participation from other stocks and not as concentrated on those big caps. So this has been an earnings driven rally. The earnings have surprised to the upside, and they continue to be very strong. This story is not about as much about heavy speculation. It's just about earnings have surprised much better than expected. Well, I started earlier mentioning that the Fed, or that the market expects the Fed to possibly raise interest rates 1 or 2 quarters of a point, or about a half a point. The implication of this chart says, well, what happens when the Federal Reserve raises interest rates? Now, typically, when they raise interest rates, they're trying to slow down the economy, slow down inflation, and usually the market gets into a bit of a stumble and a challenge. Well, in green there, this is and in the different colors, it's breaking them down into how the Fed is approaching raising interest rates. Are they trying to really quickly slow down inflation and the economy? Then that would be a fast tightening or raising cycle. Well, that's in orange, and that would suggest that we'd have a little bit of challenges in the marketplace. In green there is if they are a slow tightening cycle, meaning it's not really a tightening cycle. They are just trying to calibrate where the interest rate should be and neutralize risks of inflation, deflation, stable prices, and maximum employment. So They're just trying to fine tune. That would be our base case, meaning that, the market may get spooked a little bit that, okay, they're raising rates, but really that could fade quickly when they realize, well, this is just a slow, maybe not even raising it all that much. So this would not take us off kind of our thesis or the cyclical bull market. And just to end on a high note, since we're in July, July is actually the strongest month for S&P 500 returns, breaking it down. Now, the fourth quarter is historically strong, but July actually is the individual month. Not every month is positive. 60% of S&P 500 months are positive, but nevertheless, I thought this was a good chart to end July on since we had it.
You're like a July cheerleader.
Well, sometimes it'll kick off a summer rally.
Yeah. So the main go away is more say hi in July, stop by in July or something like that.
I like that. That's perfect. Yeah. Yeah. So sometimes you get a
Yeah.
sell off in May and then June,
Yeah.
into June, and then July kind of kicks off maybe a summer rally.
Yeah, this year I'm always looking forward to election time and trying to figure out where the market might head during that time. And then there's just a normal contrarian thing that usually markets have 14, 15% downturns every year. And we haven't seen one in a while. So I wonder what your thoughts are on that.
Well, I think the market had a pretty quick one with the Iranian conflict in the first quarter. It was, yeah, if you blinked, the market really did not, it went down and then went right back up. So it didn't have, that feel. You didn't even have time to really feel the pain of a decline, if you will. So it did have that one and bounced back very quickly. I would agree with you though that you have a midterm election year. Second year of presidential cycle is historically the weakest of the 4-year cycle.
Sure.
And then I think you have, the Mag 7 weakening here, so the largest stocks weakening. So you have a little bit of a case for, well, maybe the market should be entering a pullback. And this is about the time period from here into the election that historically has seen weakness. So we are aware of it. But without the Fed raising interest rates too high, and if oil's in that $70 range, now I think that's a risk if, oil escalates from here and then inflation comes back. But
Yeah. Right.
it's responded a little bit, but not as much as you might expect historically. And just to add, since we're talking about it, that oil is not as big of a component in the economy as it once was. So if you take this back and we had this issue a couple decades ago, it would be a huge problem.
Mhm.
Today, we're just not as oil intensive, much more technology oriented, service orientated.
And when's the next Federal Reserve meeting? Do you know?
Yeah, 2 week or it's later in July and then it goes to
Okay.
September. So the expectations are for them to hold steady here in July and for an interest rate increase in September. And that's where I think they want to hold the line. If they get some good inflation readings, they'll hold the line. But right now, there is an expectation that there's about a 51% possibility that they raise. So it's not 95%, but
Yeah.
51.
Yeah, I guess I don't really believe it they'll raise, but the market on the one chart you show is that the market's already raised rates at the moment. But
Hmm.
that could be driven back down to that line by the fact that they do raise, then they'll do the counter and it'll drop.
True. They may say that was enough, and then they've addressed the issue,
Right.
and that's enough.
Wow. Oh, Mark, so there's a lot going on in the markets, a lot of how do I say excitement or what's the opposite of excitement? There's a lot of trouble going around the world and wars and battles and I just don't understand why the market isn't more volatile at this time. Is there a way to try to explain how the market's acting in pretty much a pretty passive way to all the volatility of the world?
Yeah, we've looked at geopolitical studies and risks, and they
Mhm.
really show a lot of short-term issues. So it can be, and very similar to kind of how oil showed that big risk and then came down. This one was actually quicker than
Yeah.
expected, especially given that you shut down the Strait of Hormuz, which carries 20% of global oil consumption. It, I think the offset was that the earnings in the U.S. were just so strong that everybody said that market participants just said this is a short-term risk. We want to make sure we're invested to get the
Right.
gains of long term. We don't want to take the risks of selling out and then trying to have to get back in when,
It'll
it could
be
be over too quick. So I think you're at that phase where there's a lot of investors that just don't want to miss out on what the potential is and how AI ultimately plays out.
yeah.
Because this story isn't necessarily over yet, even though you have some weakness in pockets,
Mhm.
perfectly healthy to reset, assess the situation. But this is a theme that's going to be with us for several years.
Oh yeah, as we get established where AI becomes normal, just becomes a part of business, part of your daily life, and then that AI and the ability to deliver AI at all the levels that they can think of when it comes to technology, it's
Hmm.
going to change a lot of things in the future. It's changing things even to the day right now. So
Yeah.
you're not AI, you're real, right, Mark?
I am real. I would use it to help.
Yeah,
But yeah,
absolutely.
yes, definitely.
I think AI is a very good tool to help us develop information, get calculations, get the support of the answer to help clients meet their needs. Well, Mark, it's been enjoyable. I'm hearing your mid-market review. Mark, we'll be at our training day financial forum, which will be September 11th. He'll fly in for that on that Friday, September 11th at Water's Edge. So I look forward to seeing you there, Mark. Thank you very much.
Yeah, definitely looking forward to it.
Yeah, it'd be great. Thank you very much, Mark.
Thanks, Brian.
That's Mark DiOrio from Brookstone Capital Management, and we went over with him all about the market. Now we're going to go to the AFG Select Portfolios, which is managed jointly by Akers Financial Group. I'm Brian Akers and Mark DiOrio. Mark DiOrio does all the trading through Brookstone, through our Charles Schwab custodians. Alex Monk will be going over our returns year to date and our portfolio. So here's Alex Monk.
My name is Alex Monk. I'm a certified financial planner here at Akers Financial Group and also one of the members of the investment committee that helps manage our Akers Financial Group select portfolios, our actively managed portfolios that we have four of, and they range from our income model, our moderate model, moderately aggressive, and then the diversifier. So I wanted to talk about how our models have done and what changes we have made and how they dovetail with what Mark has said about the market in reverse and what we think is going to be coming down the pike. So earlier this year, you may have noticed that we rebalanced some of the models towards the end of February, mid-March. And the reason behind that was a few things. We had a lot of gold positions that had run up a lot in value, and we wanted to protect some of that profit, but also rebalance the models to pick up some of the asset classes that we think are going to be the best case moving forward. And as Mark said earlier, it's been a really interesting time in the market because things like the Mag 7 or those biggest seven stocks are coming down, but the rest of the market is coming back up to support it. So it's a really nice time where the market is shifting sentiment, repricing things with a lot of positives behind it. So the changes that we made on our income model, we swapped one of our core funds, the Franklin Income Fund, for its newest ETF version for its tax efficiency, and also to rebalance some of our BDC or business direct lending funds while they were experiencing some market pressure. So that one has done 4.3 year to date, and that is geared towards current income for those that need the money now with a little bit of capital appreciation along the way. From there, we go to our moderate and moderate aggressive models, and our rebalance earlier this year for the moderate model included us going overweight to an equal weight version of the S&P 500. So, like Mark was talking before, the S&P is a price weighted index. So if the top seven stocks are the biggest, they're going to move the index. That has not been really the case here this year. So our move towards equal weight was a timely one. And then we still have allocations to growth and to technology because we feel that's going to be a big deal down the road. And we also rebalanced our gold and commodity positions to model weight. In the moderate aggressive model, we did the same thing, but we didn't go as heavy equal weight. We leaned more towards an overweight to technology, and we added in nuclear power. Power grids and powering all of this AI is a place where we feel the market is lacking, and there's technology to come and resources and new ways to produce power that the market needs. So we're going through that shakeup now of trying to find that next new scarce good in our new structured economy. And lastly, our diversifier model, which is used to diversify portfolios against your typical asset classes of stocks, bonds, cash. The main goal here was to sell our metal positions that had run way up. Gold broke 5,500 earlier this year, which was a new all-time high, and that's what triggered the timing for our rebalance. So we sized our gold and silver positions, and we added in some defense sector and some nuclear power. We also have energy and real estate in this model, as well as commodities, gold, silver, and a little bit of foreign stocks that are value-based investments. Excuse me. So overall, the diversifier this year is up 6.25. Last year, it was up north of 30%. So some pullback is normal when we have those types of run-ups in metals or other types of asset classes that pop. And that's why we rebalance to try to preserve some of those gains as the market shifts. Now, the moderate model is up 9.5 this year. The moderate aggressive model is up 11.6 this year. So the market has been the higher returning versus the diversifier, where last year metals and commodities did a lot better in comparison to the market. But as things shift, that's why we always have these actively managed portfolios, so that we have our core exposure to the market in a very cheap way through ETFs and indexed investing, as well as funds that accomplish whatever goal we're trying to do in that segment. We've had a really nice market run. And as Mark was saying, I think there's a lot of good things in the market. And we'll continue to watch as things change, sentiment changes, especially in this re-election year, midterm year that Brian was talking about. It always gets a little bit interesting. But that's why we're here, and that's why we meet with not only our investment committee, but our clients on a regular basis to make sure that the models are still sized correctly for them and how does it fit their overall portfolio. So we use these models as one of our core pieces when we're looking at how do we invest your money. We really appreciate you spending some time with us. Please, if you have any questions, always reach out to me. I'm available phone, email. No question is too small. This is what I love talking about. And we'll give it back to Brian to close things up. Thanks.
Thanks very much, Alex Monk. Well, that was the AFG Select portfolios that we managed jointly with Brookstone Capital Management out of Wheaton, Illinois. All right, so the mid-year market report looks pretty good for the year to date. We'll have to see how the market does the rest of the year. In 2026, we really think it's going to be some pauses, maybe a little bit of downturns. We're hoping that the market ends up at the end. Interest rates could change, could go up a little bit, maybe not. We'll see, right? Investing and diversification is what we do at Akers Financial Group as tied to your financial planning. We truly believe that each and every client is individual. And by being individual, we want to do financial planning for you and for your family based on what your goals are. And we begin with that. And we constantly work and build on that throughout our relationship with you. Thank you very much for listening to this talk. We do recommend that you go to our website at akersfinancial.com, AKERSfinancial.com. Check out our event page. We are inviting you to our September 11th Financial Forum. That'll be over there in Belcamp, Maryland. We'd like you to join us on a Friday of September 11th at 12:30. We have classes at 1, 2, 3, 4. At 5, we have some hors d'oeuvres, and Andy and Trish Griglock will be singing. and it should be a good time. It's about 6:30 that night. It's a great educational event for those pre-retirees, those retired, and those that want to find out more information or just feel comfortable with what they already have here at Akers Financial Group. All right, so that's a big event, September 11th. Hopefully, you're listening to our radio shows on 105.7 The Fan and WCBM 680. We're also on WBAL sometimes, so check that out. We look forward to having you at our event in September 11th. We look forward to continuing to work with you through the years. Thank you very much for your time. Take care.